Hello, welcome to today's Advisor Q&A. I'm Tony Kaye, I'm the editor of Eureka Report, and today I'm joined by Bruce Brammall and Carol Tawfik, who are both financial advisors and regular contributors to Eureka Report. Now today we're going to be talking about the government's changes to superannuation announced earlier this month, which were again changes to the announcements made in the federal budget in May. There were a number of adjustments made by the Treasurer Scott Morrison. So we wanted to talk about those and also to answer your questions. Many of you have sent in questions to us, so we'll aim to get to those today. We'll try and cover off as many of them as we can. Unfortunately, if we do run out of time, we'll aim to address those later on, probably in a column. But as I said, we'll try and get to as many as we can. So first of all, perhaps we can just have a quick chat about the changes that were announced in a couple of weeks ago by the Treasurer and how they compare to what was announced in May. There was a number of major changes made, really. So perhaps I'll throw that one open to you, Bruce.
Yeah, okay. Well, look, there's a few major changes that came out of what was announced, the new super rules, I guess, if May was the new super rules. The big one, of course, or the winners, were the ones in regards to the $500,000 lifetime non-concessional contribution super limit that's now been ditched. It's gone, and that's been replaced with a decreased limit from going down from 180,000 to 100,000 in a very similar way to what the existing rules were. The major difference will be that you won't be able to make non-concessional contributions once your super balance in total has hit 1.6 million. So that'll be super and pension, whatever you've got in super, no more non-concessional contributions once you've hit the $1.6 million. So that's the winners out of this. The losers out of this are probably the biggest group of those are the 65 to 74-year-olds who, where the government was going to drop the work test and allow people to continue to contribute to super as normal without many work tests up to age 74. So they'd have been able to put in under the new rules under the $500,000 non-concessional if they'd done it, if they'd been allowed to go through it, plus also concessional contributions without meeting the work test through until 74. Under the new rules, that's what's been dropped. That what was a big win for people between 65 and 74 is gone. And in order to be able to contribute post 65 now, you're going to need to meet a work test. So there's some big winners and some big losers.
Yeah, and that was unfortunate, the dropping of that 65 to 74-year-old
work test.
Look, we've got a whole range of different questions here, so I'll get straight into them because otherwise we'll run out of time. The first one is from Bill. It's to do with property, investment property. I'll read Bill's question. It's a bit of a long one, but Bill says, I deferred the sale of my investment property expecting the allowance for further contributions to my super post 65, what we've just been talking about. Basically Bill wants to know, is he going to be sort of stuck with a huge taxation bill, to sell the property to get it into his super? What basically can he do? There's also negative gearing implications there as well. So any advice that, I know we can't provide specific advice, but any general advice that we can give in terms of minimising tax on the sale of a property, getting the money into superannuation.
Well, Bill, I'm going to assume for a second that you're over 65 and that's why you've been delaying it to be able to get the rules that would have come in after the May budget. What would have happened, the capital gains tax hasn't changed. If you're going to sell it, then there's going to be a capital gains tax bill anyway. What was going to help you was the ability to not have to meet the work test in order to make concessional contributions into super of the $25,000 post 1 July next year. So potentially if you and your wife had jointly owned the property and there's a big capital gain of whatever, $100,000, $200,000 each, then you'd have been able to make $25,000 contributions each to super to reduce the net gain that you've made and therefore the tax on it. If you're over 65 and you're going to go ahead and sell the property now, then you're still going to have you're going to need to meet a work test in order to be able to make the contribution. So, yes, exactly. That is unfortunately, Bill, one of the big loser out of this. There are a lot of people in this situation who would have been looking forward to selling specifically investment property from 65 to 74, being able to get a lot of money into super. And they're on the winners and losers out of the new rules. They're unfortunately the losers, and it's a big loss too. There's a lot of people are celebrating being able to put in the extra, or having had the 500k contribution gone. An equal loser in this. If they've won by this much, then these people have lost by this much, and it's unfortunate, but that's the way that the government has decided to balance out the positives and the negatives on this one.
Yeah, and obviously with the value of properties being so high, it's a major hit really, in terms of getting money into super. Next question is from Jenny. I might address this one to you, Carol. Sure. Jenny asks, with the new changes to superannuation, does it mean that someone under 65 can still make a non-concessional contribution of 180,000 or use the 3-year bring forward rule of 540,000 before July 1 next year, even if they have over 1.6 million already in their super? I suppose that's the catch.
Yeah, so there has been a little bit of confusion around that one, but we've recently had a bit of clarification. So from the 1st of July 17, we will have the new non-concessional contribution limit, which is $100,000 per annum, but still with that ability to bring forward. So the question really that we've received from many clients is, well, what can I do between now and that date? Can I still use those current rules and the higher non-concessional limit? So the short answer there is yes. So right up until the end of July 17, we've got the ability to use the higher cap, the $540,000, if the funds are available. And of course, there will be some sort of transitional arrangements that will apply if you have not utilised the full cap until that date. So a little bit of care will need to be taken as we sort of flow into the new financial year. And this is quite relevant for many people, not just those that have sort of cash and savings on the sidelines that may be able to make their way into superannuation, but sort of from a strategic perspective, there could be opportunity for quite a few people here to have a look and see if they can adjust super balances between husband and wife, for example, using these rules. Coming to the point about the 1.6, again, yes, if your balance is over 1.6 today, you can still contribute to superannuation up to the current limits, and that's a real positive, because beyond the 1st of July, it will really be, essentially your last chance to get money in above the 1.6. So certainly worth exploring for some people.
Yeah, there's a bit of a window, isn't there, which people can take advantage of.
Absolutely.
If they can.
The retrospectivity, the concern about the retrospectivity of the previous rules is gone, because nothing's going back to 2007 now.
Yeah.
Nothing's going back to budget nice. Nothing's whatever. It's nice and clean. 1st of July next year is when the new rules, the new limits come in, and prior to that, it's going to operate as we know it today. $180,000 for non-concessionals, $35,000 for the over 50s, $30,000 for the under 50s. So you can use your limits as normal. You don't have to worry about that. But certainly.
It's a real positive. Yeah, good planning opportunity potentially between now and then.
Yeah, and as we always say too, if people obviously have their own specific situation and they need to get specific advice from a financial advisor.
And there's actually one other thing, Tony, here that's really important, is that we haven't seen the legislation yet. to deal with this. So we do need to wait to see some of that legislation. There will inevitably be people who get caught up in some of this.
Yeah.
So if you're turning 65 in the next couple of months, then you need to speak to an advisor just to make sure that if you're going to use the 540,000 or looking to use the 3-year pull forward, check it. I've got one client in particular I know that is turning 65 in March next year. That should be enough time, but we need to see the legislation to really be able to decide what's going on.
That's right.
Don't make any rash decisions. If you're concerned, go and speak to an advisor.
Yeah. We've already seen that things can change pretty quickly.
Very, yeah.
Yeah. Now, we've got another question here. This one's from Chris. It's also around the $1.6 million cap, but this one is under the current proposal. Is the $1.6 million cap a one-off transfer amount? Let's say that I start with $1.6 million in pension mode on July 1 next year, but by June 30 the following year, 2018, I have a balance of 1.7. Do I have to reduce the balance back to 1.6 again to maintain the fund in tax-free pension mode?
No, absolutely no. The 1.6 million, once you start that, it's 1.6 million. If you have taken a strategy where you've bought a whole bunch of speculative stocks and they all do brilliantly, and your 1.6 becomes 10 times that $16 million, then there's nothing has to be transferred back. Once you've started your pension with 1.6, whatever you gain from there is going to be able to stay in there. Conversely, if you buy a bunch of dud stocks and you turn your 1.6 into 800, you're not going to be able to retop it back up. So as the limit slowly with CPI increases from 1.6 to 1.7 to 8 to 1.89, etc., the only people who are going to be able to use that are people turning on pensions at that time. Unless you've started your pension with less than 1.6 million, let's say you start your pension with 800,000, and at a point in the future it goes to the 1.7 million, the government has made noises or made provisions. Again, we need to see the legislation, but if you're able to put in more, you might be able to put in a proportion more into a pension at that stage if you haven't used your full 1.6 million. So where that might help people is they get an inheritance or something like that in their 60s. They've started a pension at 62, and at 64 they get an inheritance of an amount that they want to get into super and be able to start a pension with, and that might be able to help them potentially later beyond 65. But again, they're going to have to make work tests in order to be able to do that sort of thing.
Yeah, yeah.
So just to expand on that, it'll apply on a proportionate basis effectively. So Bruce, you mentioned that if you started with 800,000, if the cap then increases to 1.7, with your 800, you used 50% of that $1.6 million cap. If that cap then goes up to 1.7, you've still got 50% to go, so potentially 850. So it'll apply on a proportionate basis is what we've seen so far.
Yep.
Good. All right, thanks for answering that one. We've got a lot to get through, so we'll get on to the next one straight away. This is also from Bill. Another Bill, I think. My wife and I will turn 65 and will not be eligible for an age pension. Bill's in a receipt of a military pension that covers all living expenses and carries sufficient tax credit to offset any immediate tax liability. We're thinking of withdrawing all of our super funds and investing them in managed funds and using the associated income franking credits to travel. Do you foresee any specific drawbacks in this plan?
Yes. Anytime you pull money out of superannuation, you're pulling it out of a very low tax environment. You need to see somebody about this bill, you need to talk to them about it, but the military pension is one thing. We don't know whether it's defined benefit or not. Let's just assume it is for a second. If you have other money in superannuation, then we don't know how much it is, but if you've got other significant money in superannuation, then leaving it inside superannuation and potentially putting it into a pension will mean that the pension fund isn't taxed. Anything you receive from the pension fund in the way of income streams isn't taxed. If you pull that money out of super, then it's coming back into a taxable environment. So depending on what other assets you've got outside of super, you may be taxed on that money. If you're pulling out $300,000 each out of super, and you're going to have, and the only other assets that you have outside of super are $300,000 each for husband and wife, and they're the only assets you've got, and you're earning 5% on that, then if there's $15,000 each in income, then you're unlikely to be paying any tax because you're not going over the 18,200. But we're going to come to a point where we have sort of three buckets. You'll have your $1.6 million pension, untaxed. You'll be able to have an amount of money outside of super, investments outside of super that are generating money, and so long as it doesn't go above 18,200, no tax. Then the third bucket is going to be if you're over the 1.6 and you've got $500,000 or whatever outside generating that 18,200, the rest of it will go, you'll want to keep inside super accumulation where it's only being taxed at 15 or 10%. So not enough information there, Bill, but I'd really recommend you go and see somebody before you pull the money out of super.
Yep. Okay, thanks for that, Bruce. Next one is from Eric. Again, we're coming back to property here. There's a lot of questions around property, but having property in my super, I would be interested as to how this would be valued on the 1st of July 2017 as unlike shares, which obviously you can get a value on straight away. What does someone need to do in terms of getting a valuation on their property? Carol, did you want to tackle that one?
Yeah, look, I haven't seen anything to suggest that what applies today will be different in the new super world. So the ATO's guidance on this isn't terribly hard and fast as to how and when you need to value property, other than, as we know, it's the trustee's obligation to make sure that the assets of the fund are appropriately valued, and this is important for a range of reasons like reporting on performance and pension payments, and of course now also for this 1.6 million. So my understanding is that it is not so much as to who does the valuation, but how you're able to substantiate that, and I can't see that it will be any different here in this circumstance. So, be it a valuer, a real estate agent, or yourself, the issue, however, is that you need to substantiate how you've come to that valuation, and the auditor of the fund's accounts needs to be comfortable and happy with that. So, I would imagine maybe that this is a trigger point for property to be valued, but we haven't seen anything specific as to anything new or different that now needs to be done other than to do what we have always done in the past.
So you don't want to just go onto a website and punch in your address and use that valuation. You're going to need to go, as you always have done, you've got to go a little bit further.
Get a signed valuation.
Well, it doesn't
Not
have to be signed, but you need
yeah.
to put some numbers around what you've done. If you think that your property's worth 600, 800, 1.2 million, you need to have some science behind it. Now, if you're getting a valuer or a real estate agent to do it, then they've got the material, the tools to be able to put some sort of reasonable numbers around the valuation. I think it will be a really important issue come June 30, July 1, when pensions are going to have to be ticked on. I think part of what this question might also be, is that if you've got $1 million worth of equities in your super fund or your pension fund, and there's another $1 million worth of property in it, obviously there's $2 million there. You're going to have to make some decisions about what assets are going to stay under the 1.6 and what assets you're going to transfer out. Now, that sort of person might transfer $400,000 of equities back out into super and leave the property in the pension fund with $600,000 worth of equities, or they might make a decision that they want to keep the whole $1 million worth of equities in and a portion of the property in. But in that case, look, we assume at the moment, again, we haven't heard anything to the contrary, that in that case 60% of the property would stay in the pension fund and the other 40% would be treated as if in being an accumulation or super. Yeah.
Okay, thanks, Bruce. Carol, this one's addressed personally to you.
Oh, okay.
You're very lucky. From Mary. I'm 41 and have a low super balance because I've been out of the workforce at various times. And I understand that those with low super can make extra contributions, so we get to the catch-up provisions. How would that actually work?
Okay, so the catch-up provisions originally slated to commence from the 1st of July, they've been pushed out to 2018. So what they allow for is that an individual who has less than $500,000 in superannuation can take any unused concessional contributions from previous years and use them in 1 year. So as we know, the concessional contribution, salary sacrifice contributions on which you can claim a tax deduction is reducing to $25,000. So the little catch here with this one is that it's coming in on the 1st of July 18. The first year in which you can apply this will be the 19-20 financial year. So you'll only begin to accrue unused concessional contributions from the 1st of July 2018. So if we assume, for example, in that year, one contributes $15,000 in concessional contributions, in the 19-20 financial year, you'll have the remaining, beg your pardon, 10, and the 25 for the 19-20 year. So $35,000 that you could make in that 1 year. So the issue, of course, is having the funds available to do that. But you can see that this provision would work really very well for people who might have lumpy income due to self-employment, people who, for example, circumstances have changed, they've paid off the mortgage and suddenly there's more cash flow available. Potentially also in cases where there is a large tax event in 1 year, like a capital gain, you may be able to then use that those unused contributions to make a nice sort of larger deductible contribution in 1 year. So I think this is a good policy. It's a shame it's been pushed out a little bit, but I think it's going to present some really good opportunities for a lot of people to top up their funds and sort of other strategic opportunities as well. So I think it's a good thing.
Yeah, I think it's long overdue, and it's great that the government's taken the initiative on that to bring it in.
Yeah.
Yeah. Good. Thanks very much, Carol. Got a question from Sarah. Sarah's retired, and actually I'm not sure I'm following Sarah on the early part of her question. I'm retired and in the latter years of my working life. Was able to really ramp up my super by the way of salary sacrifice. Okay, I've got it now. As a result of this and the good advice I received at the time, I was able to really make good use of the tax benefits and save a sum that will mean that she will not be a burden on the system. It seems that there is now considerable disadvantage for my children in terms of what they can contribute and the incentive to do so. This is a worry. How much did the proposals affect them and what advice can you give? So I think perhaps what Sarah's getting at here is that with the annual contribution amount perhaps being cut down to $25,000,
yes,
what sort of impact is that going to have on a younger person over the term of their working life, having that lower level? Because we've gone effectively from 50,000 down to 35,000.
Well, 100,000. Yeah,
sorry.
Absolutely.
Go back even further.
Yes.
Down to 25. So
yeah, so absolutely, Sarah might be in this category of people who got the benefit of those much higher contribution limits years ago. And I think, like many retirees today, spent most of their working life focusing on paying down the mortgage, getting kids through school and all the rest, and then dedicating the latter years of their working life to really getting good contributions into superannuation. So now with that limit coming down, gradually now to $25,000, I think gone are the days of just largely ignoring superannuation for most of your working life and relying upon those pre-retirement years to get funds in. So, it's really critical, I think, for younger people today to give consideration to starting their contribution or increasing their contribution from much earlier in their working life in order to have any chance of building a healthy balance at the point of their retirement. Difficulty, of course, is convincing a younger person, perhaps with a younger family, that they should be putting some of their surplus income into superannuation. But when you really look at the evidence of that effective compounding of just making small, consistent contributions early on, and that benefit over and above just making sort of a larger contribution at the end, it's really quite sort of compelling. So we just need to be having more conversations, I think, with younger people, and perhaps it's an opportunity for people to speak with their children about getting advice and making that commitment to contribute to super from much earlier on than perhaps they did.
Yeah.
I think people need to start basically from exactly what Carol's saying here is from their late 30s. Basically, it needs to be if they're getting their 9.5% or the like. That's fine, that's good, but you've got to start earlier. And I think it's now sort of your mid to late 30s, 35 to 40. Start making extra contribution, even if it is a couple of $100 a month, or $200 a month is $2,400 a year. If you can get to $5,000 a year, there's a tax saving there. There's an immediate tax saving there, and you're getting far more money into super. But we're going to have to do that. And this generation, the Gen X and Gen Y, is going to have to do that. Start earlier, late 30s, pump more money into super, because unlike the previous generation, boomers and retirees, who were able to pump money in, literally shovel money into super in their 50s when the mortgage is paid down and the kids are off their hands, they could pump in $100,000 a year per job. If they had a couple of jobs, they could put in $200,000 or $300,000 a year. But they were able to shovel money into super. We're not going to have that. It's never going to return for people under 50.
Yeah.
Got to be more consistent. It's got to start earlier.
Too true. And I think ASFA, the Association of Superannuation Funds, have got a nice little calculator on their website which allows people just to say, what difference would it make if I, put in a couple of $1,000s a year, sort of what over time. And
I think people would be surprised actually when you really look at the numbers of the effect of making small consistent contributions early on is really, that's the magic of compounding really. So it's compelling when you can see it.
Absolutely. Okay, so we'll move on. We've got a question from Alistair. I understand that the reason for a lot of the changes is to make it harder to pass on residual amounts in super to my children. Well, I guess that's true, Alistair. Will it still be possible for my children to get any super left when Alistair and his wife eventually passes away? So it's the shifting of excess super to the children. This brings into the whole issue of dependence and non-dependence, I suppose.
Yeah, well, the government has said that they don't want super being used as an estate planning tool. So that's one of the bigger reasons for doing what they're doing and trying to stop people building $5 million, $10 million funds, being able to withdraw it just before they die and have this tax-free money going to the kids, which can happen now, which can happen now. One of the things they're trying to stamp out. So what people are going to be able to do going forward is going to change a bit around the $1.6 million. But part of what this question is in regards to dependence and non-dependence. In regards to handing on your super, there is an element of tax to pay if your money is being passed to a non-dependent. Generally, kids are older than 18 or something. There's an amount of tax to pay if it's being paid direct from a super fund. If it's not, if it's going to a dependent, a spouse, children under 18, then they can generally get it tax free.
Okay, great. We're getting closer to the time, so I just wanted to push through a few more questions if we can. We won't get to everyone's question unfortunately today, but we'll do our best to answer your questions offline via Eureka report. Next question's from Brian. It's around the $1.6 million cap again. There's a lot of questions around this. The new legislation says that income balances of less than $1.6 million will be tax exempt in retirement, and any excess can be taken out. Presumably, it makes sense to take out all low yielding assets, as there is no cap on the income that can be made from the $1.6 million. That's the question. So money left in your super, earnings from the $1.6 million can continue to accrue. I think we pretty much covered that off.
I think, yeah, and if I'm sort of hearing that correctly, it in part relates to what Bruce was talking about with the three buckets in terms of you've got your 1.6 inside the tax-free pension mode, and if you exceed the 1.6, what then do you do? Do you transfer it back to accumulation mode where the earnings will be taxed at 15%, or do you take the other option, which is to remove it from the superannuation environment completely? So Bruce certainly touched on that before, where there is a bit of thinking that needs to be done around the structure of those three buckets, bearing in mind that every individual can probably hold several $100,000 in their own personal name before they would begin to incur a tax bill in their own hand. So 18,200 or 20,000 thereabouts is the tax-free threshold for an individual. So if there is an excess of the 1.6, a little bit of thinking just needs to be done about what proportion should stay in accumulation and whether anything should come out. But we'd certainly suggest you receive some advice before taking money out of the superannuation environment, because of course the limitations with getting it back in.
Yeah, I think there's a second part to this question as well, Tony, is are you moving low yielding assets from, if you've got to transfer money from pension back to super, what assets are you transferring? I think this is going to be something that's going to be different for everybody, and it'll be as individual as a fingerprint almost. If you are prepared to take larger risk, then you might be prepared to leave in your 1.6 million. If you've got 3 million or so, you've got to transfer 1.4 back. If you've got the 1.6 million that you've got to stay, what assets are you going to keep in there? You're going to keep in growth assets, you're going to keep the Australian shares and property, you're going to keep that in there and potentially transfer back the cash and the fixed interest, the lower growth, lower total return assets, or you're going to take it the other way and leave the stuff that's going to generate all the cash or all the income streams, coupons from bonds. You're going to leave that in your super and transfer back your shares and property. So, or you're going to do a mix of of two of those,
Yeah.
and leave them proportionally in and outside of super. It's something that if you're not comfortable about what you're doing, again, sit down with an advisor to help you sort of plan what sort of risks you're prepared to take, involved in what you leave inside your pension fund and what you're bringing back out to either accumulation or potentially outside of accumulation and into your personal name.
Yep, exactly right, because everyone's situation's different. Move on to James's question here. One of the draft changes is that employers can make tax-deductible contributions up to $25,000 less what their employer puts in. Can the excess contribution be deducted against other taxable income like rent, dividends? Will the excess contribution still be subject to tax of 15% inside super?
The short answer to that one is yes. So you can, if you have, you've got the $25,000 concessional limit. Some of it might be used up by way of your salary sacrifice or your 9.5%. You can top that up to 25 and have that offset against other income, as this person has asked, rental income and those other things. So that is the short answer to the question. Anyone can make a contribution up to the $25,000 and have it be a tax deductible contribution.
Okay.
Yeah, so if you're adding in, say, $10,000 at the end of a year to you, direct in your super fund because you've only used, $10,000 or $15,000 by way of SG and salary sacrifice with your employer, then the $10,000 becomes a tax deduction in your own name. But part of that is that the $10,000 that you put in, yes, will be taxed at 15%.
Yes.
But you'll lose the 15% when you put the $10,000 in, but you'll get a bigger tax deduction in your personal name. So there'll be a net advantage, almost like you organise your employer to do the salary sacrifice.
So that was a positive out of the changes, of course, as well. That was a recent change, yeah.
Yep. Good. Got a couple of long questions left. I'm conscious of the time, but we'll try and get to one or two more. There's a question from Greg. My wife and I each have balances in their self-managed super fund in excess of 1.6 million. 99% has been pensioners transition to retirement. There's 63 and 62 respectively. Currently all of the SMS income is tax-free and all pension distributions returned to the SMF are non-concessional contributions. We're both working, although they can retire at any time. What are the implications for us both being under 65 if we continue to work up to and beyond 65? there's probably an element of the work test in here. If all the assets in the SMSF are accumulation phase post July 1, 2017, is there tax payable beyond the 15% from the funds in the pensions paid from the funds? Does that make sense?
Do you want to go?
Yeah, so from what I'm understanding is both members of the couple with the self-managed super fund have transitioned to retirement pensions.
Yep.
And they're both working and they're under 65. So one of the changes was that transition to retirement pensions would no longer carry that tax-free status on the earnings. So effectively, while they will still remain in pension mode as such, the earnings within will be taxed at 15%. So that was, that's sort of been talked about for some years, I suppose, the workings of the transition to retirement pension, and whether they were being used for their purpose and all of those sorts of things, rather than just sort of a tax vehicle. So this couple will face a change, certainly if they continue to work. The tax on the earnings within the fund will revert back to the 15%, even though they will still be transitioned to retirement pensions as such.
While they're still working, though,
While they're still working.
If they are able to, or they do change jobs after age 60, and I have written a column about this if anybody wants to go back and have a look at it. If you do change, end an employment arrangement after age 60, then you will want to get your funds changed, or your pension fund changed from a TTR pension to an account-based pension, at which time you'll escape the TTR tax rules, the new TTR tax rules, and you'll be turning on an account-based pension that is over 60 and ceased an employment arrangement or retired, and have it changed so that it stops paying tax immediately. So this is going to become a really important strategy, particularly for people over 60.
Great. We'll take one last question from Bronte, and then we'll wind up. We haven't got to every question today, but we'll certainly address them. Perhaps Carol and Bruce can work on addressing them in their columns.
Sure.
Around the different changes. But the last one's from Bronte, around the work rules as far as non-concessional contributions to self-managed super funds. How do they work in terms of self-employed people, such as a day trader?
Day traders will be a little bit different. You've got to probably have the tax office rule that it's employment, or your accountant or something give you advice in regards to whether it's considered employment. I've seen some bad consequences come out of, bad results come out of people, particularly in that day trading space, as to whether they're considered to be employed or self-employed. So it's something that you'll need to get specific advice on, I would think. Certainly, if not from your advisor, then from your accountant, as to how that would be treated and whether you are actually self-employed and being able to make those deductions in a tax-deductible way. Yep.
Good advice on that one, Bruce. That's all we have time for today, unfortunately. So I'm Tony Kaye, editor of Eureka Report. We'll be posting this Q&A up to the website, so you can have a listen back to any of the questions if you're unsure. Always feel free to send in your questions as well to either Carol or Bruce, and they'll be able to look at those questions and either reply personally or address them in their columns. And we look forward to you joining us next time. I'm Tony Kaye. We'll see you again.